3 facts, 1 screen. Let me read them slowly because each one matters. Fact 1, silver crashed to $80 today. Fact 2, the United States bombed Iran's Kar Island this morning, the island responsible for roughly 90% of Iran's oil exports. Fact 3, 2 days ago, JP Morgan purchased 18 million ounces of physical silver. Now here is the important part. Do not react to any one of these facts by itself. Do not look at the $80 price and panic. Do not look at the bombing and assume you already understand the impact. Do not look at JP Morgan's purchase and dismiss it as coincidence. Look at all 3 together, because when you connect these 3 dots, when you draw the line between what is happening in the physical world, what is happening on the battlefield, and what one of the most powerful financial institutions on the planet just did with its own capital, the picture that emerges is not the one most retail investors are seeing right now. And that gap between perception and reality is the entire point of this video. Before we go further, I need to say something clearly. Everything discussed here is for educational and informational purposes only. I am not a financial advisor, I'm not a licensed investment professional, and nothing in this video should ever be interpreted as advice to buy, sell, or hold silver, gold, oil, or any other asset. Markets are volatile. This week alone proved that. Silver moved from $83 to $90 and back down to $80 in just 7 days. Those kinds of swings can be extremely dangerous if you are leveraged or overexposed. Always do your own research. Speak with a qualified financial professional before making investment decisions. And never risk money you cannot afford to lose. This channel exists for one reason only: financial transparency and education. With that said, let's connect the dots. If you're watching for the first time, subscribe now and turn on notifications. This is day 8 of a series that began on March 8th when the US-Israel conflict with Iran escalated and the Strait of Hormuz effectively went dark. Every video this week has been built on real data: COMEX warehouse numbers, institutional delivery reports, physical market premiums, and live geopolitical developments. Today's video is the summary, the dot connection video, the moment where everything from the past week comes together. If you have been following the series, this is where it all clicks. If you are new, this is your entry point into one of the most important commodity market stories unfolding this decade. Let's begin with dot number 1, the bombing of Kar Island. Most people have never heard of Kar Island. It is not famous. It rarely appears in headlines. But in terms of global energy infrastructure, it is one of the most strategically important locations on Earth. Kar Island sits roughly 30 kilometers off the Iranian coast in the Persian Gulf. It functions as the central export hub for Iranian crude oil. Nearly 90% of Iran's oil exports pass through that single island. The facility processes close to 950 million barrels of oil every year. It includes massive storage complexes, deep water terminals capable of loading supertankers, and pipelines that transport crude directly from the Iranian mainland to the export terminals. In simple terms, if someone wanted to design a single choke point capable of crippling Iran's oil exports, Kar Island would be it. And today, that location was struck. According to multiple international reports, U.S. forces targeted military infrastructure on the island. A video of the strike was publicly posted, and the message accompanying it was very clear. If Iran continues interfering with traffic in the Strait of Hormuz, future strikes may target oil infrastructure directly, not just military targets near the oil hub. The oil facilities themselves. That statement dramatically raises the stakes for the global oil market. Iran remains one of the largest oil producers in the world. Even with sanctions and wartime disruptions, its export infrastructure is still a significant contributor to global supply. When the possibility emerges that those exports could be removed entirely, even temporarily, energy markets have to start pricing that risk. Oil had already surged above $90 earlier in the week due to war-related supply fears. Now the market must consider something even bigger: the potential destruction of one of the largest oil export systems in the Middle East. That is dot number 1. Now let's move to dot number 2, silver crashing to $80. At first glance, this seems confusing. A major geopolitical escalation should normally support precious metals, yet silver fell sharply today. Mainstream financial outlets all gave the same explanation: dollar strength. The US dollar index surged, and because silver is priced globally in dollars, a stronger dollar pushes the metal's dollar price lower. This is basic market mechanics. When the dollar strengthens, it takes fewer dollars to purchase the same ounce of silver. The nominal price drops, even if physical demand remains unchanged. But here's the deeper question. Why did the dollar surge today? Because of the strike. Whenever the United States launches a major military operation, global investors historically move capital into what they perceive as the safest assets available. That usually means U.S. Treasury bonds in U.S. dollars. This flight to safety strengthens the dollar, and when the dollar rises quickly, precious metals often fall temporarily in response. So the silver drop today was not caused by collapsing demand. It was not caused by a surge in supply. It was not triggered by any change in COMEX delivery stress or physical market premiums. It was triggered by a currency move that itself was triggered by a geopolitical event. The chain reaction is simple. The strike strengthened the dollar. The stronger dollar pushed the paper silver price lower. That is dot number 2. Now we come to dot number 3. 2 days before today's events, JP Morgan purchased 18 million ounces of physical silver. The purchase occurred on March 12th, when silver was trading roughly between $84 and $85 per ounce. Today, the price sits near $80. On paper, that means JP Morgan is currently showing a loss of around $3 to $4 per ounce on that purchase. Multiply that by 18 million ounces, and you get a temporary paper loss somewhere between $54 million and $72 million. So here's the question you need to ask yourself. Does JP Morgan accidentally lose $70 million? This is the same bank that operates one of the most advanced commodities trading desks on the planet. The same bank that already holds hundreds of millions of ounces of physical silver. The same institution that paid a $920 million settlement in 2020 related to precious metals trading practices, and then emerged from that period as one of the dominant holders of physical silver globally. Do institutions like that randomly buy 18 million ounces at the wrong moment? Or do they buy because they believe the current price does not reflect where the market is heading next? That is not a question I can answer for you. But the way you answer it will shape how you interpret the $80 price today. Now let's connect all 3 dots. A major oil export hub tied to 90% of Iranian exports has been attacked. The United States has publicly threatened to escalate further if maritime disruption continues. That means the risk to global oil supply has not decreased. It has increased. If Iran's oil infrastructure were ever removed from the market entirely, even temporarily, the effect on global energy prices could be enormous. Oil would not stop at $100. Under extreme supply disruption scenarios, it could move far higher. And when oil prices surge dramatically, the cost of producing commodities rises across the board. Mining, refining, and transporting metals requires enormous energy inputs. Higher oil prices raise the cost floor under metals like silver. At the same time, geopolitical instability and inflation fears tend to drive safe haven demand back into precious metals. Now place JP Morgan's purchase into that broader context. They accumulated 18 million ounces before the strike. They did it while the March COMEX delivery cycle is entering one of its most stressed phases. They did it while physical inventories remain tight and institutional demand remains elevated. And 2 days later, the price falls because the dollar surged after a geopolitical escalation. So if you were holding 18 million ounces purchased at $84, would you panic because the paper price touched $80? Or would you be watching the broader geopolitical and supply situation and thinking about whether the market is mispricing risk? That is the entire point of connecting these dots. As we move into the week of March 16th, several structural factors remain extremely important. The March COMEX delivery cycle is still active. Registered inventory levels remain relatively limited compared to total open interest. Physical market indicators, such as lease rates and international price premiums, continue to signal tightness in the lending and delivery system. And large institutional players continue adjusting their positions.